name is Michael Bazzy. Just want to double check before I start. Reynaldo, can you hear me okay? Can everybody hear me okay?
Yes. Can hear
Okay,
you okay, yeah.
wonderful. It's my pleasure to share some of my time and experience with you. As Reynaldo stated, I did used to work for FXCM. I actually started with that company in 2002, where they were still growing. It was still a small company, and I was with them for about 4 years until around 2006, 2007. So since then, I've kind of been doing my own thing. I am an investor. I have been managing my family's portfolio, and I had the pleasure of meeting Reynaldo last week here in Chicago at a meetup for traders, and he was happy to know that I used to work in the company where most of you were trading, and I had a little bit of background and information when it comes to how FX brokers work and how FX market makers work. So really, I just want to say one more thing before I start. For the past 6 or 7 years, and even until now, I have no affiliation currently with FXCM. So I'm not going to be pitching or selling anything. I'm really here just as a favor to share some of my knowledge, share some of my experience, because I was a senior manager on the desk, and I pretty much dealt with every kind of question and concern that traders had with the company. So I wanted to make this a casual kind of open forum. I did have a short slideshow and presentation, just some of the basic things that I think that every FX trader should know. Whether you're just starting out, whether you're more of an intermediate or an advanced trader, I think it's important to understand the structure of the FX market, how it's different from trading stocks or from trading futures or options. Especially if you have that background, there's some things that are different that you need to know, and that will help explain some of the concerns, some of the questions, some of the issues that people have, like price differences, like discrepancies between charts sometimes, like different quality of execution that can be very different from company to company. So once we go through that, we'll just open up the floor, and if you guys have any kind of specific issues that you've dealt with or specific questions, I can try to help explain why that is to the best of my knowledge. Some things have changed since I've left the company. Regulation has changed. The amount of services and options that are provided to traders have changed. But I have done my research, and I've actually talked to FXCM to clarify some things that weren't clear. So hopefully I'm up to date, and I'll be able to answer any questions that you have. I'm going to go ahead and start the slideshow here. And although this may seem a little bit basic, just bear with me. I think it's important to understand the fundamental differences in the structure of the foreign exchange market. If anybody has been coming from a background of stock trading, or if they've traded futures or options, they're familiar with an exchange-traded instrument, basically. These exchanges exist in a physical location, like it's the New York Stock Exchange, or it's the Chicago Mercantile Exchange, or it's the Chicago Board of Trade, or Chicago Board Options Exchange. These were set up to centralize the market. And basically what that means is that the exchange or the clearinghouse holds the responsibility of matching buyers and sellers in the market. So whether you're a retail trader, whether you're an institution, whether you're a hedge fund, basically you're coming in on an equal footing. And you're not really concerned with who your counterparty is. You actually, when you buy a futures contract, you don't actually know who the seller is in the market. That's, it doesn't really matter. It's the clearinghouse's job to match buyers and sellers and to ensure that people meet their obligations in margin requirements and whether they, owe money, if they make or lose money. When it comes to an over-the-counter market, it's very different, and this is important to know. Basically, all that it means for an over-the-counter market is you don't have a centralized exchange. Orders and transactions and people buying and selling, they're not going to one central place like the New York Stock Exchange. Basically, if you're trading a stock that's listed on the New York Stock Exchange, regardless of who you are, your order has to go through and gets cleared by that exchange. So if we look at the lower part of this slide, this is just a graphical representation of where we stand as traders in this market and the role that companies like FXCM provide to retail traders. If you can see here, I'm sure everybody's heard of the interbank market. This is basically the biggest banks in the market. Citibank, JP Morgan, Credit Suisse, UBS, Deutsche Bank, who make up what we call the interbank market. They're made up of some of the biggest institutions in the world, and historically, they kind of make up the exchange. It's not located at any one location. It's a global exchange, and the way that they're connected is electronically. What they have typically used in the past is something called either an EBS or a Reuters system. We're going to get to that in just a second and see what that looks like. But basically, as an individual trader, if you wanted to trade this market, it was very, very difficult to access it. And the reason why is because most individual traders don't have enough money. They don't trade enough volume. They don't have the millions of dollars that are needed to set up the credit lines and the relationships and accounts with all these different banks in order for them to be able to buy and sell from them the way that they do with each other. Just to give you guys an example, if right now, I mean, I'm sure all of us have a savings or checking account, if we walk into our local bank and we try to buy 10,000 euros, for whatever reason, whether it's speculation, whether you're going on vacation to Europe with your family, you can bet that the price that you're going to get quoted is very, very different than the prices that you see on your trading screen. I would say on average it could be up to a few hundred pips markup. And that sounds ridiculous. Obviously, as a speculator, for somebody who's trading and looking for the best price, that's not reasonable. You know, that's usually the case when you need a physical delivery of the currency and they're able to charge you that kind of markup. Big high net worth individuals in the past have been able to set up relationships with these big banks and trade, but primarily it's over the phone, and this is something that's kind of in the past. The market has changed a lot with the electronic currency networks and with all the platforms that are available that give you access. But basically what I'm trying to get at is that the role of FXCM is to act as a middleman. Because they have relationships with some of the biggest banks and institutions in the world, they have those credit lines, they are able to get that kind of preferred pricing. Just to give you an idea of how these banks trade with each other, the average spread on a highly liquid currency pair like the euro, US dollar, on average throughout the day could be something like 0.1 to 0.2 pips. I've seen it on many occasions be 0 pips, meaning that the bid and the sell and the ask price, the sell and the buy price that you see on the screen when you compare it from different banks is exactly the same. That's how liquid and that's how low of a cost it is when these banks trade with each other. But that being said, their standard lot size is 1 million euros. They don't have anything like a micro or mini lot, which is something that the retail traders have been able to provide by breaking it down for you. What do they do? How do they make their money? Whether it's FXCM or Gain Capital or any other kind of currency market maker, basically the best way to describe it is that whatever prices they're getting, they're simply marking it up. And that shows either as a wider spread or in some cases a commission that's added on top of that. And the way that these companies make money is purely on volume. They're interested in having customers open accounts through them and placing as much trades as possible. Now, we're going to talk about the potential conflicts of interest, some of the dealing practices which are a bit shady, some of the concerns that you may have, but let's move forward to the next slide here. Just to recap quickly, these are some of the products on the left in the over-the-counter market that are not traded through an exchange. You're traded directly with the counterparty, whether it's forwards, penny stocks, swaps, or in our case, we're talking about spot FX. And some of the other financial instruments that we're more familiar with, like large cap stocks, futures, options, corporate bonds, and ETFs, those all go through a centralized exchange. Basically, the role of the exchange is to provide transparency. It centralizes the communication of the bid and offer prices to all market participants. And you can either respond by buying or selling at one of the quotes that you see, or you can reply with a different quote, placing like a limit order or an entry order in between the spread or at different points if you have a direct access platform. When it comes to over-the-counter markets, although it's less formal, it's still very organized, but it's basically just an electronic network of relationships centered around one or more dealers, and these are the dealers that act as market makers by quoting the prices which they sell or buy. Now what that means for us basically, the point is that this does not mean that they quote the same prices to other dealers as they post to customers, and they don't necessarily quote the same prices to all customers. This is the key difference when we're talking about an over-the-counter market. Basically, just like when you go shopping, you can find different prices at different dealers and different places. There's nothing that's centralized for where everybody sees the same price at the same time. That's why when you go to the bank and you try to buy 10,000 euros, it's 300 pips more expensive than a large fund or a bank that's trading at the same bank. This is an example of how traders access an exchange-traded market. We call it either a direct access or a level 2 platform. Anybody who, who's a professional trader who's had experience trading something like a stock would recognize this. The main difference that we're going to see here and between the FXCM trading station is something called market depth. Basically what this does, because this is all going through one exchange, it aggregates and it shows all the order flow from different buyers and sellers in the market. So here, for example, and what it does is it kind of separates it so that you're able to see the best bid and the best offer on either side, and you're able to see the relative size for each bid and offer. This is called depth. You not only see what the prices is, but how many shares you can trade at that price at that moment in time. As you come down the book, you see obviously the bid becomes a little bit less here. You don't get as good of a bid price, but for somebody trying to fill a big order, this shows the size, how many shares they can fill at that particular price. When an order is executed, and this is another very important thing to consider, when an order is executed on an exchange-traded platform, everybody is able to see it. And this is why when we look at the prices on a ticker tape or on a chart, that shows the last executed price that went through the exchange. That's different than when we look at a chart and then over-the-counter market, and we're going to talk about that a little bit more. But basically here you can actually see every single sell and buy order that goes through. That's tracked. Everybody's able to see it. Everybody's looking at the same numbers. These are screenshots of the platforms that the banks use to trade with each other. These are the most popular ones used at the ECB level. They're called the Reuters deal book, if I'm not mistaken. It used to be called the Reuters Platform 3000. And on the right here, it's something that used to be the ECB. It got bought out by another company. But basically the point that I'm trying to show is that the way that banks trade with each other, it's very similar to how the level 2 platform works. They're able to see exactly who the participants are, who's putting the bids and offers in, and what size they're putting in. That's called market depth. That's something that as a retail trader we don't really have access to. The only way that we can have access to that kind of information is if we had a relationship with Citibank and HSBC and JP Morgan, the way that they're kind of showed here. And not all, some smaller banks don't have relationships with all the big banks, so they're limited as to what prices they can get. Obviously, a company like FXCM or a bank like Deutsche Bank would have a credit line extended with the biggest banks and be able in that way to get the best possible bid or offer available in the market. We'll come back to this concept in a little bit because for a lot of professional traders, this is very important information. Knowing the depth of the market, knowing exactly how much you can execute at each price is important. Engaging market sentiment, engaging what kind of execution you're going to get, and we'll see what are the options available to traders who want to trade like that. Basically, just to summarize, this is just a very basic idea that helps us understand where we fit in the overall market. For any of us, whether we're Marks or Sams or Michaels or John, we're over here. A company like FXCM or another market maker would be one of these guys. Now this relationship has changed. One thing to note is that since I used to work in this business, and now there's been a lot of competition. You have hundreds, if not thousands, of brokers that offer the same service as FXCM do. In the United States, it's become a little bit more limited because of the capital requirements and the regulatory requirements which have changed over the past few years. It's really come down to just a handful of the biggest companies who can offer this service. But for anybody, I'm not sure if anybody is overseas here, obviously you have so many different Forex trading companies that are based in Europe or the Middle East or Asia, and they basically work in the same way. They establish relationships with each other or with banks, whether it's through an ECN platform or through the Reuters or EBS platform, and they're trying to get the best possible prices, and what they're selling you is that they're passing along those best possible prices to you with the markup. But what we'll see in a little bit is that the actual price being passed along to you can vary, and the quality of service and execution that you get can vary. So these are things that you want to consider when you choose who you want to trade with and the quality of service and execution that you're getting with them. Obviously, this is something that we're all familiar with. I just wanted to show it to highlight the difference between what you see on the FXCM trading station and what they see when they trade with each other at the interbank level. Basically, they've kind of simplified it, they've streamed it down to you, where the concept is that, okay, we're getting all these different prices from the banks, all we're going to do is try to show you the best price. So we don't really care about, you know, what UBS is offering if Citibank is giving us a better bid price for the Euro EOS dollar. We're going to go ahead and stream that to you directly. You don't know where the source of this liquidity is or where the source of this price is, but we'll basically show it to you, and then obviously there's a spread which shows you the difference between the buy and the sell price. Now here's the thing. This screenshot shows, for example, a 3-pip spread between the bid and the ask on the Euro US dollar. More than likely, the spread that FXCM is receiving, or any market maker is receiving when they have relationship with these big banks, is something like 0.1 or 0.2. So you're talking about a significant markup. This is basically how they make money. This is how they're able to make money and offer something that's commission-free. A lot of people don't understand that. How are they making money if it's not commission? They're marking up the spread. The same way that if you walked into a bank and tried to buy 10,000 euros, it's not going to be a 3-pip spread, it's going to be a 300-pip spread. If anybody's ever tried to use their credit card in Italy or France, and there's a kind of foreign exchange transaction, you're basically getting ripped off. And that's basically how an over-the-counter market works. Now here's the thing. Because you've had so much more competition the past 5, 6, and 7 years, so many companies are trying to provide the same service, companies are trying to differentiate themselves in the pricing models that they're offering their customers. So for example, when I was working at FXCM, this was really the only option, the dealing desk option. You opened up accounts with them, and their dealing desk was the counterparty to your trades. So basically, when you were buying euros, they were selling them to you. And obviously, there is some conflicts of interest to consider when you trade with a dealing desk in that manner. But before we get to that, since then, they have offered multiple pricing models for different types of traders who are looking to get better pricing, to kind of obviously lower the costs of trading, but also to provide different options for different styles of trading. In my time, scalpers were not very welcome. People who scalp the market, and my definition of a scalper is anybody who's in and out in a matter of seconds or minutes, either looking to take advantage of price arbitrage, price discrepancies in the market, or really just, it's basically opening and closing positions within a matter of seconds. This would pose a problem for the dealing desk, and we'll get to that in just a second. But because that's a very, very popular form of trading, they did offer new price models like the no dealing desk option and the active trader option for people who do want to trade like that, or who are using like an automated trading system and who don't manually place their trades. Instead, they have a computer or algorithm which places multiple trades. This is something that we'll talk about in just a second. But if we look at this table, this is actually taken directly from their website. One would ask themselves, why in the world would I want to trade with a spread of 2.7 pips if I'm able to trade at 0.9 pips? The answer to that is that, obviously, if anybody is asked about the active trader account, it requires a much higher deposit and a significant amount of volume per month in order to qualify for that. Just like anything else, when we go shopping, I mean, if we're buying a single serving item, it's going to cost so much, and if we go to Costco and we buy a wholesale item at much larger quantities, it's obviously cheaper. It's the same idea here. We'll get back to what the best option is for your type of trading and for your type of account in just a second. But what I wanted to, there's one other thing I wanted to discuss here. Yes, I believe what FXCM is recommending to most new accounts is for them to go on the no dealing desk option. This actually wasn't available 5 or 6 years ago. Basically, their explanation of how this works is that it's straight through processing. Your orders go directly to the liquidity provider on the other side. You don't know who it is. You don't see the depth of the market. But basically, you have to kind of accept the fact that you're getting the best bid and ask that they're getting plus their markup. Now 2.7 pips, like we said, as opposed to 0.1 or 0.2 or 0.5, let's say that that's the average, 0.5, that is a significant markup. But all that they're concerned with in this particular example is volume. The more trades that are placed, the more markup they make. They really have no preference as to which side of the market you're on, whether you're making or losing money, because they're not on the other side of the transaction, supposedly. We'll come back to that in just a second. This is also taken from the website, and it describes exactly what we were talking about. Basically, how their price models work and how they're different. I've highlighted some things to consider here, some kind of red flags that we can just talk about briefly. What's the reason, do you think, that they have a maximum balance for the dealing desk? The fact of the matter is, and they actually explicitly stated here, I think they had to for regulatory reasons, FXCM can profit when trading losses of its clients on some currency pairs. Basically, if you lose money on the dealing desk option, they have the option, and most likely they are profiting from your loss. So why would they limit this? Because it works the other way also. If you have a very large account and you're dealing directly with their dealing desk, by you making a lot of money by scalping or by placing a large transaction and taking that profit quickly, that would translate into a direct loss for them. That's with this model, the dealing desk model here. Here's some other things to consider, which they explicitly state as disclaimers on their website. FXCM can see your stop, limit, and entry orders, but they claim FXCM does not requote orders or manipulate prices. Now listen, I'm not here to bash FXCM. They are actually, in my opinion, I worked for them for many years, one of the more reputable brokers. But what you need to consider as a trader is that the moment that you place a trade with this pricing model, there is an inherent conflict of interest. You are not just dealing with a broker anymore, you're trading with a counterparty, somebody who's taken the other side of that. So whether they are actually manipulating or trying to skew the prices, we'll talk about some of the practices that different companies use. No, they're probably not as bad, and they're probably very reputable now after some of the issues that they've had. The fact remains that a conflict of interest does exist. So, and you'll especially see that if your manner of trading is scalping, and they say that here, scalping is allowed, but FXCM reserves the right to manage its risk by changing your execution type. The moment that they feel that your method of trading is risky to them, or it's not compatible with what they want, they reserve the right to automatically take you off their dealing desk option and put you on the no dealing desk option, where then they don't really care what you're doing, they're just taking a markup on every trade. This will come into question, and I know some people want to ask, well, okay, I want to take advantage of the smaller spreads on the dealing desk. How can I do that without getting requoted, without getting, bad execution? We'll get to that in just a second. News traders. This is another note that they've made here. For people who wait for a volatile news event like non-farm payrolls, this is probably not where you want to be trading. This price model is not going to help you, because at moments like that, from our experience, and I'm sure everybody's seen it, when the market goes crazy, when spreads widen, when there's a lot of volatility, liquidity can dry up for a few minutes. You can't get filled. You can't get in or out of your order, and if you do, you can't get the price that you want. This is much more likely on the dealing desk model, obviously, because FXCM is not going to want to take the risk of the market gapping 50 or 100 pips in one direction. Let's talk in more detail about what it means to trade on the dealing desk model, which is the option that some traders still have. Basically, when you're going long, the dealing desk is simultaneously going short. Just see if I can. Okay. Since many customers are buying and selling simultaneously, the dealing desk would have a net position. What that means is that very rarely does FXCM track what one particular trader is doing. They have enough liquidity. There's enough buyers and sellers where they're really more concerned with the net position of their books. So basically, some people are buying, some people are selling. It's all happening at different prices. What the back system does is it aggregates what the net position is and what the net price is for that position. So obviously, it's not going to be exact. There's always going to be a net long or net short position. That's what the dealing desk is managing. So this should provide a little bit of comfort. Some people feel like they're getting singled out sometimes. That being said, there are situations, obviously, if you have an extra large account or if you're trading extraordinary large positions, where every transaction you make all of a sudden changes their net book. And I can think of a couple examples. I had brought in a client from Saudi Arabia who had a $35 million account. And every single trade he was placing was at least 100 million euros or 100 million pounds. Obviously, every time he comes in the market, the dealers in the FXCM dealing group would monitor his trade on a trade-to-trade basis and then decide how they would manage that risk. In some cases, they would simply take the other side of the trade. To be honest, he wasn't the best trader and he lost most of his money very quickly. His losses, in that case, translated directly to FXCM's profits. In other cases, they may not want to take that risk. They'll allow the trader to execute his very large transaction and then immediately go into the interbank market and offset that risk at a better price. So basically just kind of make a profit on the price discrepancy. Sometimes they hold on to it for a few minutes before offsetting it and trying to get an even better price. Now the problem is, I'm not sure if anybody's ever felt that this has happened to them, but if the FXCM dealing desk is managing your position on a trade-to-trade basis, it is possible that you may get requoted. It is possible that you can't get filled at exactly the price that you want, or you get a partial fill, because basically FXCM is making sure that whatever price you get, they're getting a better price. If the market doesn't allow them to get a better price in that situation, you probably won't get the price that you want. This is obviously a direct conflict of interest between clients and a dealer. In other words, we already said it, if the net position of clients loses money, this translates into a direct profit for the dealer. This is why, if you feel that you're a scalper or you're a high-frequency trader or you're in and out in a matter of seconds, dealing desks don't like scalpers. Scalping basically involves opening and closing the trade within a short period of time, and this causes a headache. Not because you by yourself, I mean, if you're trading a micro lot very quickly, this does very little harm to them, but when 500 or 1,000 or 5,000 other people are doing the same thing, it becomes a hassle for their dealing desk to manage that. The net exposure of that book that we're talking about, that net book, fluctuates very quickly from minute to minute, and usually to their short-term disadvantage. Now here's the thing. I'm sure you've all heard this statistic. In the long run, the majority of traders, I think it's something close to 80 or 85%, I've actually heard 90%, from what some companies have told me, will lose money in the long run. So the majority of scalpers, when volatility picks up, all the small gains that they've accumulated will give them back and then some when there's a big move against them. In this particular case, the dealing desk would basically make back their losses when you lose your money. Despite the long-term advantage, the desks hate watching the equity drain slowly every day. That's why when scalpers try to trade using this method on the dealing desk model, the result is poor execution. They may feel like there's some kind of price shading or dealer intervention. That's why FXCM is recommending them. They created this new pricing model. They want to switch people over to the no dealing desk model. If you like scalping the markets, most likely the dealing desk pricing model is not a good idea for you. This is, I think, what most of you want to hear about. What are some of the questionable dealing practices that market makers engage in? Now, I just want to make something clear. This is in no way a description of how FXCM does business. I have actually dealt with a few market makers, a few brokers. This is just a general idea of what it means to trade with a dealing desk, what it means when a conflict of interest exists between you and the broker that you trade with. Price shading is when the dealing desk skews the price slightly up or down depending on how they feel the market is moving at that moment in time. So even though the spreads may be very reasonable, it might be a 1 pip spread or 1.5 pip spread, because the price is skewed at that moment in time, you may not actually be getting the best possible price as you think that you are. Just to give you an example, let's say that you have some kind of news event or some kind of rally in the market. Obviously, the dealing desk can see that. If a dealing desk wants to shade the price, basically what they would do is this. they'll give you a very nice spread, but it'll be higher in one direction. So if you as a buyer, let's say that you have two options from two different dealers. One of them is giving you a 3-pip spread, where the bid is 131.00, 131.03, and then another desk which is shading the price a little bit to 131.04, 131.05. The 1-pip spread looks much more attractive, but as a buyer, when you're actually coming in, buying at 131.05 is more expensive than buying at 131.03. The second quote, let's say you were a seller coming in here, it seems like a deal. 131.04 seems like a really nice, it's a higher price to sell at, but if the market is rallying at this moment in time, you're getting a great deal, but you're going to lose your money very quickly because the market is going up. Basically, in this kind of situation, the dealing desk is trading just like you are. They're making a bet on how the market is moving in any certain direction, and if you can't really see this unless you have a price feed from multiple providers. Unless you're able to compare the prices that you're trading at with one dealer to what the prices are in another dealer, or if you have access to an interbank spread, only then can you see if the market has been kind of manipulated up or down by 5 pips or 10 pips or 15 pips. Manipulated is not the best term. It's an over-the-counter market. Just like when we go to the supermarket here, anybody is free to price something how they want to, and it's up to you whether you choose to buy or sell at that price. A higher price might be a disadvantage to a buyer, but it might be an advantage to a seller. But this is something that some people feel happen, especially with the smaller dealing desks who don't have the kind of liquidity that FXCM has. They kind of have to move the price according to what they feel that most of their customers are doing. When they only have 50 or 100 or 500 traders, it's easier to gauge what the overall book is looking like and what most of the traders are going to be doing. Poor execution is the real hidden cost of trading. And this is something that people will complain about. It really depends on the quality of the service and the market maker that you're with. Basically, no matter how good the spreads are, no matter how good the service is, when you can't get filled at the price that you want, it's basically an added cost to your trading. And this is the term that we call slippage. It can apply to market orders, it can apply to entry orders, limit or stop orders. Good trading platforms and good platforms have been able to provide options like FXCM with good to cancel orders, immediate or cancel orders, and fill or kill orders. Basically, all that does is it gives you the ability to manage that risk more. So you're able to say, okay, I'm only want my order to fill at this price. If not, cancel it. But then there's a chance that you don't get filled at all. Or you can say that fill this order at best that you can at that price, and if you can't fill the rest of it, cancel that. Or you can just say, just fill my order at the very best price. If the market is volatile, you may get a partial fill at one price, and then the rest of your order is filled at a worse price. When that happens, it doesn't really matter anymore if we're talking about a 1 or 2 pip spread. If people are trading news in this manner, and you're getting filled at a 50 pip spread or a 100 pip spread, it doesn't really matter anymore. All that matters is getting the best possible execution at that time. Dealer intervention is another way of talking about requotes. If you try to buy or sell at a certain price, all of a sudden you get a message on your platform. I'm not sure if this happens frequently anymore, but it's likely to happen if you're on the dealing desk model and you are placing very large orders or you are scalping. You simply may get a requote, you can't buy at that price, here's a new price to buy it at. That's a problem, especially if you're in a position that you're trying to get out of. You may keep getting requoted and then you can't get out until it's too late at a significantly worse price. This is really just another form of poor execution. A big concern, and this is something that Reynaldo had asked me to talk about, was the concept of running stops. Here's the thing. When you are trading with a dealing desk, the dealing desk is able to see exactly where your stops and where your limits are. Conceivably, if they wanted to, because we know that there's something called price shading, the price can be brought up or down if they feel that there's a lot of stop orders at a certain level. And a lot of people sometimes feel like, oh, I've been targeted. I got stopped out at that level. In most cases than none, it's because that they're placing their stops at a significant support or resistance level, and the market price is stopping them out. I mean, the market sometimes moves toward these support and resistance levels. People didn't give themselves enough of a leeway to protect their position. That being said, and we're going to show an example, I actually pulled up a couple of charts from today, it is possible to see a 10, 15, 20 pip price discrepancy between one company and another. And that makes a person wonder if, in fact, the price was manipulated specifically to take out where significant stop levels are and to close out positions. There's really not much you can do about that except compare the price that you have it dealt with to other providers. If it's significantly different and it's something that consistently happens as a practice, it may call into question the reputation of the broker doing that. In my experience, FXCM doesn't really have a need to do that. When they were first starting out and the number of customers was far fewer, and really the only option was a dealing desk option, it was more questionable. Now, they really don't have that advantage. If they skew the price up in one direction, some people might get stopped out, some people might get filled. You know, some people might be taking their losses, some people might be taking their... There's enough buyers and sellers at any given point in time where there's really no advantage to a large company that's providing liquidity to a lot of customers to skew the price in one direction or another. The only exception I can think of is if you're one of those big fish trading hundreds of millions of dollars, your stop is a few pips away, it's very possible that the price gets moved a couple of pips to stop you out in that particular situation. I'm not sure if that situation really applies to everybody. We're really talking about positions in the hundreds of millions in this case. In my opinion, from my experience, the dealing desk model really only makes sense for swing and carry traders. If you know that you're going to hold a position for at least a few hours, I'm talking like 5 or 6 hours, or if you're going to be a swing trader, carry it for a couple of days, or a carry trader for a couple of weeks or months, obviously you still have the disadvantages and the conflicts of interest of dealing with the dealing desk, but those factors are much less likely to apply the longer that you hold the position. So somebody who carry trades, who's looking to take advantage of the interest rate differential with a multi-month long-term position, they really have little reason to be concerned. And in this particular situation only, it might make sense, in my opinion, to take advantage of the lower spreads because it's about a 40% difference in the prices of trading. From my experience, the way that most traders trade, and obviously if you have a smaller account, you're looking to hold positions for a few minutes, you're looking at a 1 minute, a 5 minute charge, the ideal way to trade is with the no dealing desk option. Obviously the disadvantage is the spreads are higher, double in some cases, but it lets traders worry about trading, about risk management, about developing their strategy without having to concern themselves with possible conflicts of interest, execution issues, wondering if somebody's chasing your stops or not. You basically are paying for the extra peace of mind by paying 1 or 2 pips more on every trade that you place. The best option is looking for an ECN type platform that has pass-through execution where you can see transparency in pricing and market depth. Now, although you can't see that with the regular FX trading station, it's my understanding that they have a new option called the active trader. And that's the one that requires a significantly larger balance and significantly higher trading volumes. This is a screenshot of what their active trader looks like. You can see the difference here is that you have the market depth. You can clearly see before you place your order exactly what price how much of your order is going to get filled and at which prices. So you can see, for example, here's 1 million. Here's another million at the next price. Here's 7.5 million at the next price. This really makes sense for people who are placing much larger orders, and the idea of the active trader platform is exactly the same as the no dealing desk platform. The only difference is you're able to see the depth, and the only other difference is that the markup is not as much. So instead of a 2.7 spread on the euro dollar, I think in this example we have a 0.7 spread. That's significant. Now, there is an added commission to trade this, and the way that FXCM justifies that is that, okay, we're not marking up your spread, this is how we're getting paid. The small commission, if we're talking about $3, that really only translates to about 0.3 pips. So if we're going to add them up, a 0.7 spread, which we see on the platform, plus a $3 commission, that really only comes out to a 1 pip spread, which still beats the 2.7 pips, which is the average spread on the regular no dealer platform. I want to just mention one thing here. Although FXCM has a lot of great advantages, notably their customer service, the ease of how the platform works, the variety of different resources, charts, and views and recommendations that they offer, the fact of the matter is, if you are looking to trade this kind of ECN, active trader market depth model, they're probably, if you look hard enough in the market, are able to find cheaper options. Basically tighter spreads and a guarantee that the broker that you're trading with is passing your order through onto their liquidity providers. They're not taking the other side of the transaction, and more competitive spreads and commissions. Even though we see 0.7 pips here, that's not likely the spread that they're seeing on their interbank platform. There is still markup, it's probably just not as much, you know, and that's how they're able to justify adding that extra commission to this particular transaction. The one other thing that I used to get so many questions about is, why did my order get executed? Why did I get stopped out at this price? Why did my limit not get triggered? How come I didn't take profit? A lot of times it gets confusing, especially now that we know that we're talking about an over-the-counter market, about price discrepancies between different charting packages. I actually took these two screenshots today. These are just a few hours old, and I wanted to show an example. The chart on the left is a screenshot from the NetDania charts. They're actually a free chart service provider. They don't offer trading as of yet. They're going to in a little bit, but they offer a number of different charts that have really cool features in my opinion, but the source of the pricing is different from FXCM. It's a third-party charting provider. I'm not sure exactly which provider they do, but they have multiple price feed options, and I believe in one case the price feed is like an aggregate. It's an average of different sources. It takes the average bid-ask price, and that's what it plots. I put the cursor on a candle here. This is July 30th, and the time, if you can see that at the bottom, is 14:05. That's 2:05 p.m. my time, Central Time. I'm here in Chicago. What it showed was, and this is a minute chart, the low in this particular minute comes up as 1.32600. Now here's two things to consider. The reason why I wanted to show this is that whatever charting package you're using, whether it's one of the FXCM charts or a third-party package, the first thing that you have to consider is what's the time zone option that you've selected on that chart. In my case, I'm looking at things at Central Time. So this particular minute, which is 14:05, if I wanted to compare that to the pricing on the FXCM platform, by default it's Eastern Standard Time. So in this particular case, this candle is the one that I want to be looking at, 15:05, they're 1 hour ahead. Does anybody see a significant difference here? It's actually a pretty big difference. This particular minute at 15:05, which relates to 14:05 my time, over here we have a low on the FXCM chart of 1.32628 as opposed to a low of 132,600. We're talking about a different low bid price of 28 pips, which in my opinion is significant. This is a little bit hard to explain. Basically, the low price during that minute on FXCM never went that low. But according to a third-party provider, it came down 28 pips lower. It makes one question the validity of either of those prices. Who's more accurate at that moment in time? Who's closer to where the interbanks were traded? The only way to know that is to really compare your pricing with other sources and see who's more out of line with who. Is this a mistake? Is it wrong? There's no such thing as really a wrong or right price. In this particular situation, at that minute, this provider on the left had a lower price. That might have hurt some people. It might have stopped some people out. It might have helped some people. If somebody came in and bought at that lower price, they could have made a bigger profit with the rally that happened in the next few minutes. So there's always, you have to consider both sides of a price discrepancy in any situation. Now obviously, if you were long and you got stopped out in this particular case, it might make you question whether the price was manipulated to your disadvantage, whether you were stopped out on purpose. In FXCM's case here, that wasn't the case. One other thing I wanted to talk about, a lot of times people call me up and they tell me, let me use an example here. Let's say that we were trading with the provider on the left here. In this situation, let's say that you had an order, an entry order, a limit order to buy at 132,600. According to the chart, it reached that low. But you need to ask yourself, am I looking at bid prices or ask prices? In this case, it's the bid price, which is the sell price. If the sell price reached 132,600, it's very likely that the buy price at that moment in time was 2 or 3 pips higher. And that's a good reason for why an order may not have been executed. If you were telling the system to buy at 132,600, but the buy price was 2 pips higher at that moment in time, that's basically the reason why you weren't executed. So most of the time when people used to call us up and ask us, why was I triggered, why was I stopped out, they weren't considering the bid-ask difference. Now, I did speak to one of the representatives today, and they've made it much easier. You can actually toggle in the charts within the FXCM trading station between the bid and ask prices to see the difference at any moment in time. And also, depending on what price model that you're trading on, if you were using the no dealing desk option, the charts automatically show the price history of that. If you're on the dealing desk option, obviously the price history might be slightly different. The charts also show that, so it's much less likely to get confused. This really only matters if you're using something like TradeStation, NinjaTrader, if you're using your own third-party provider where the price feed may not be FXCM's price feed. The one other thing, which rarely happens, but it does happen sometimes, is the concept of a price spike or an incorrect technological spike in the price feed. A glitch or a lag may result from one of the liquidity providers that FXCM works with, and usually it's very obvious, like this chart shows. You can actually see the price significantly spike down, something obscene, and then come back up to where it was trading. Anytime you have a doubt about that, obviously the first thing you want to do is confirm with other pricing sources to see if this was a real market move. It's very possible if a news event came out, if the market is not very liquid, this can create a low liquidity, high volatility situation where spreads become insanely wide. I mean, I've heard of certain situations where the spread can come up as 50 or 80 pips, and that's why it comes up as a spike at that moment in time. Confirm whether you're looking at the bid or ask price. If you believe that it has to be wrong, I mean, there's no way the price is way out of line with any other pricing or chart that you're looking at, it is possible that it is a bad price. You know, something came through from one of the banks or liquidity providers off, and that skewed the price up or down. They do have a trade audit department. You can ask for a trade audit to be run, and they can confirm whether this was an incorrect or correct price on their system at that time. And I've done many audits. You know, mistakes used to happen. I'm not sure how common they are these days, but if for whatever reason you got stopped out or a position was taken out or an order got triggered incorrectly, there are situations where they can reverse that, where they can put your position back in the market or completely cancel it if it worked against you. This is really basically the main concerns that traders used to have. I want to open up the floor. If you guys had any kind of specific situation, any kind of specific question about what I talked about or something that happened with you, please feel free to ask. I'll be happy to to provide as much information as I can. Is there something that I should be doing, Reynaldo, to end the slideshow here? Unfortunately, I'm not hearing anybody. Are you with me, Reynaldo?
Oh, sorry. Okay, I'm the one who's being being muted. But nevertheless, yes, I have no questions on my end. However, thank you very much, Michael. I actually learned a few more things today. So, no, we have a question from Jason. Jason basically stated that just happened to me an unknown order, then FXCM audited the trade and credited me back to loss. So what causes that? So in actual fact, you guys can actually ask if you have a mic, you can ask Michael directly rather than typing it in. That would be actually much better. So what causes that, Michael?
If I'm understanding correctly, Jason, you had no orders pending, and an order came out of the blue and actually got executed on the trading platform?
That's correct. I thought it was a user error at first, but then we did an audit actually on the order in class and found out that there was no pending orders based on how I usually structure my trades. And so when I actually went to FXCM online on the chat and ran the issue by them. They did an audit on it, and then they sent an email out to me this morning and said that basically I was credited back the loss of the trade.
Okay.
So I thought it was interesting because I was in a bullish bias on my position,
Okay.
and what happened was once the order had filled, or I was actually stopped out, then the order immediately went short. About 3 mini lots. So, and I know for a fact I didn't do that. So after looking into it, yeah, I guess it confirms something happened.
Right. Sometimes, I mean, I understand that you're pretty sure that you didn't do that. The first thing that we would check when we run an audit, sometimes a person puts an order in the opposite direction for a different amount. So if they were long one lot, for example, they didn't realize that instead of putting a stop on the position, they have like an entry order to go short 2 lots. So that order winds up closing out one position and reopening up another position. I understand that what you're saying is that that's not the case. You basically had an order that came from out of the blue. What you could ask for, and what we used to send out customers in that situation, is a copy of the trade audit. It actually shows, the system is very precise. It actually tracks the IP address of your computer for every order submitted. Even if an order is canceled and never got executed, there's a record of it, the time that it was placed and the IP address that it was placed from. If an order came in from a different IP address, we would question or ask the person if anybody else had access to their login information. If it was initiated by the dealing desk itself, there's a specific IP address that shows that as well. So wherever that order came from, there is actually a very technical and specific way to track the IP address, the moment in time it was created, and how and why it was executed. When we ran trade audits, we would try to explain that for customers. We wouldn't always send them a copy of the audit because it's a little bit difficult to read and understand. But that information, if you want to get to the bottom of it, is available and you could ask for it.
Gotcha. Good to know. Thank you, Michael.
My pleasure.
All right, perfect. There's another question from Rupert. Basically, Rupert stated that the so-called MT4 backend, can the broker change just my chart and not all traders? Not all traders, if that makes sense.
That's a good question. No, they can't. Basically, even if you're using MT4, it's a different charting, it's a different software than the FX trading station, but ultimately the information that's getting streamed to it is through an API, an application program interface. Ultimately, you're still connecting to the same server that everybody else is trading on. So it's a good question. Can the broker manipulate the price that you see where everybody else on that server sees another price? No, you're all logging in. If they change it for one, it's changed for all. And that's why it's not to their advantage to significantly skew the price up or down, because if it's higher than where it should be, sellers are getting a great deal. If it's lower than where it should be, buyers are getting a great deal. And you'd theoretically be able to take advantage of that.
Alrighty, thank you very much.
Does that answer your question, Rupert? Just to add to that, the only time where customers might see different prices from other customers is if they are on a different server. An active trader will see a slightly different price than somebody on the no dealing desk option who will see a different price than on the dealing desk option. And it's that slight spread discrepancy that we were talking about. Those are managed on different servers. So depending on what kind of account and login that you have, when you log in, you're logging into that particular server for the price model that you've chosen.
Beautiful. Very nice. Thank you. Okay. Arthur stated that an active trader got 2 options, one with less spread with a commission or a higher spread with no commission. Which one should Arthur choose?
This is a great question. And actually, I maybe didn't talk about that as much as I should. When it comes down to it, this answer varies according to what kind of trader you are. If you have a micro account or a mini account, you probably don't qualify for the active trader. If you have a significantly larger account, I'm not sure what the deposit requirements are. They have a separate department and somebody that you can talk to where you can have access to those higher spreads. Now, even though you have that big deposit, they may require you to place a certain number of trades, a certain amount of volume per month in order to qualify for those preferred and lower spreads. Here's the thing. You don't want to change the way that you trade to try to get a discount. If you're going to be over trading and you're going to blow yourself up just because you're trying to get a better price, that really defeats the purpose. You have to determine what kind of trader you are. If you go back and you look at your report and you're placing significant volume per month and you have a significant account with FXCM, the active trader option is the best option. The commission, just like we talked about, if we're talking about a $3.50 commission, which I think is what they quote, and by the way, this is negotiable. If you do more volume than what they require, and if your account is significantly large enough, you can try to negotiate your commissions down to $3 or $2.50 or $2. It really, you have to kind of like haggle a little bit to get the best possible price. But that let's say it's a $3 commission, that translates to a 0.3 pips difference in the spread. So if we're talking about a significantly lower spread, add 0.3 to that, compare it to what you would see on the no dealing desk option, and more likely you're saving money for every single trade. On average, I think they quoted as about a 40 to 45% savings on all of your transactions. If you're not going to be trading that kind of volume, or you only take on a position a couple times a week, to be honest with you, it's not going to make too much of a difference. I would go with the no dealing desk option, not worry about the kind of conflict of interest that we were talking about, and just really focus on getting in and getting out and managing your risk properly.
Thank you, Michael. Did I answer your question? Yeah, beautiful. Okay, Subramani will have a question.
Sure.
So, Manny, you unmuted yourself. You muted yourself, so you just unmute you, Manny. Yeah, there you go.
A couple of traders have left, but I just want to, I think FXCM has a lot of great advantages. I wanted to recommend, shop around. You'd be surprised how many, I mean, there's so much competition in the market. I would say that FXCM is not the cheapest. If you're looking specifically for this lowest spreads and the lowest commission, if you're looking to use like an ECN kind of, direct market access, there are actually cheaper options out there. Now, I haven't traded with them. I can't speak for their service and for what they provide, but just to give you an example, from what I've seen, and I've compared a spreadsheet of the different spreads, Interactive Brokers and MB Trading, which I think is Manhattan Beach Trading, consistently have lower spreads on an average basis when you compare them to FXCM. And they also have a very small commission, which is how they make their money on those transactions. But it's just something to kind of look around, to kind of shop around. If you feel like, if this is something that's important to you, if that 1 or 2 extra pips makes a difference to you, if you shop around, you could find maybe cheaper markets, cheaper options out there.
All right, beautiful. Manny, your turn. Thanks, Michael.
Sure.
Hello, Manny. Manny? Is your... Yes, now we can hear you. Yeah, there you go.
Michael, this is a very general question. Nothing to do with the technology spreads or whatever you mentioned about. You just mentioned one point which went into my mind. You mentioned that FXCM tracks the IP address of the computer, executing the trade, etc. Right? Is that correct?
It's not something that's that the dealers look at on a trade-to-trade basis, but the server does record that information for every single trade that's placed. Not only trades that are executed, but even orders that were placed and then were canceled. Even if an order was never filled, there is a record of it in the system at exactly the moment that it was placed, to the minute and to the second, and the IP address from which it came from. So if a person ever doubts, oh, this did not come from my computer, they're actually able to check what their IP address is and to the IP address that's on the system. We had some situations where a person had shared their login information with a colleague or with a broker, and trades were being placed without their knowledge. That's how we would be able to know that kind of information. Or sometimes somebody would call in a trade. They opened it on the system, and then they called the dealing desk to close it, and they denied it. Not only is there a recorded conversation of that, but also it shows that the trade was initiated by the dealing desk and not by the person because they called it in.
Okay, let me ask the question in another way. Let's say, I have an account in the United States, okay?
I'm sorry, could you just raise your voice a little bit? I'm having...
Is it better, Michael? Is it better?
Yes, this is a bit better.
Let's say an example, I have an account in the United States, and I have my brother in India who may log into my account and trade. Would that be a problem for the regulatory guys?
it wouldn't be a problem. You don't necessarily have to log in from one IP address to place your trade, but it would show, if for whatever reason you disputed that trade, it would show that it was initiated by your brother. The IP address would be significantly different from yours. I think the first 3 digits of every IP address tracks which continent it comes from. And that's why FXCM doesn't recommend that you share your information. It's really at your own risk. You don't know if he gave it to anybody else, if he left your account open, if he was like at a cafe or something like that, and somebody placed a trade. It would show that, but I don't believe it would be a problem. There may be a security setting that you can ask for where it limits which IP addresses that it comes from, but during my time there, that's not the case. As long as somebody had access to the information and logged in, they could place a trade from anywhere that they wanted to. But you needed to know.
Got it. No problem. Because this is a 24/7 market. Obviously, not one person would be able to sit and enter the orders all the time. We may want to have, somebody else execute the order on behalf of us.
That's understandable. You know what? There was one safety feature that I remember during my time. Two people could not log into the same account at the same time. This was actually a feature that was customizable in the back office. If you requested that, they can turn it off, and then both you and your brother or your cousin could actually be in the trading station in the same account at the same time. Obviously, you want to be very careful because if one person is buying, the other person is selling, you're closing each other out. You don't want to do things that are conflicting with each other. But this was a feature that was available, and it's something that's worth asking about if it's important to you.
Fantastic. Thanks a lot, Michael. Just want to understand, that's all I got. Okay, thank you.
My pleasure, sir. My pleasure.
Okay, thanks, Sabrina. Yes, from Rupert. Rupert said it would be okay, like if you were on vacation in another country.
Oh yeah, absolutely. I mean, I've never had an issue with that. Even if you were trading on the downloadable trading platform from home, they do have a web browser option. If you even went to a public computer, you can probably log into your account on the web option if you didn't have your laptop with you. It's not an issue where you log in from. As long as your login information is secure and you don't share it with anybody else if you don't want anybody else to do that.
All right, perfect. Any other questions for Michael and Charles, Harry, Lolita, Jason, Sue, Vitas? Okay, do you use FXCM yourself, or would you recommend another broker?
I'm a little bit hesitant to recommend. I mean, if I were a beginner trader, if I was, learning the foreign exchange markets, as far as retail foreign exchange provides, FXCM has really, in my opinion, a very good all-encompassing solution. The resources, the services that they provide, the ease of how the trading station works and how quickly it is to learn it. I mean, there's a reason why they've become the biggest retail provider in the world, is because they're good across the board. But if you're looking specifically, and you consider yourself more of an active trader, you do have a significant amount of positions and volume that you do, it is worth looking into brokers that may provide a more cost-efficient option like the ones that we were talking about. If you shopped around, you could probably find some place that offers good execution and probably get a better price every single time that you trade. In the long run, that kind of saving adds up. I'm not sure about how good their service is. Interactive brokers, for example, from what I've heard, they tend to deal with more of an institutional client base. They deal with money managers, fund managers. They don't have the patience sometimes to ask kind of the basic things that we're talking about today. They may not provide the kind of service that you got used to from FXCM. So that's one thing to consider depending on what's important for you.
All right, thank you, Michael. Actually, talking about that, yeah, just one question on my end. So, like, if more higher volume type of trading, like, cause I know Citibank or Citigroup has a platform.
Yeah, I've heard of CityFX actually.
Yeah, CityFX. So, in other words, if you want to be more of an active trader, then it's also highly recommend to have a look into that area as well. Then going directly to the bank.
It's possible. The thing is, some banks, they may actually be able to provide very good prices in some currency pairs and not so good prices in other currency pairs. even when banks are trading with each other on the interbank EBS system, they tend to use Reuters for certain currency pairs, and they tend to use the EBS platform for other currency pairs. Some are more liquid on one, some are more liquid on the other. And because there's so many participants, there's so many banks involved, that's how you get the best possible price. When you want to trade in this manner, if you want straight through processing and you're trying to get liquidity directly from a bank, it could be that Citi's prices are very competitive. It could be that if you deal with an ECM that connects you not just with Citi, but Deutsche, UBS, Royal Bank of Canada, Bank of Australia, when you have all those more providers, they're competing with each other, it's even possible to get an even better price than just one of those big banks. And then you just kind of have to compare it along with the small commission. Where is it consistently on average better for me to trade? You kind of just have to try out and put them side by side and look at how the spreads are and how the prices are throughout the day, and that's the best way to make that kind of decision.
Thank you. Beautiful. Alrighty. Any other questions for Michael?
Hey Michael, how are you?
Sure, go ahead.
I know we're talking about price and spreads predominantly, but because the nature of our trading is more swing-term trading or a little bit long, short to medium-term, longer-term trading, it's not really that much of a factor. But what's really important, and I'm going into the path of equities here as well, is market depth. I mean, if I can see some form of order build-up on the long side or the short side, it really would enhance the trading per se, seeing where the big buyers are coming into. Now, I know there's other providers that have order book and show some depth. Is FXCM going to go down that path to provide it to the retail trader?
From my understanding, I'm not sure if you were with me in the beginning of the presentation, but the option that they call the active trader option shows market depth. Now, the thing is, you don't see who the depth is. You just see the different order sizes and prices as you would in a level 2 platform. You don't necessarily know who that belongs to. So it's not as transparent as you
But on equities, we have like an X or an XT, which determines that it's an institution. Do they have that on the currency side as well?
Probably not, no. I mean, they'll only show you so much in that particular case. It makes you feel like you're trading on a level 2 platform. The only way that you would really have the same information that you might be used to on the equity side is if, in fact, you were working with a pure ECM broker. Typically, you would need a larger account, and then you would know exactly who was on the, who was placing that order, which bank it was, and how much they were posting for every bid and offer that they had.
Okay, so that would be more like an institutional broker per se.
Listen, I mean, the way that the market has evolved the past 7 years, it's become much more accessible. It's not as exclusive as it was to just the big players. What I would do is really research ECN platforms, straight-through processing platforms. You can take a look at something called Curnex. There's FXall, if I'm not mistaken. A lot of them are based in Europe. I would definitely consider looking at them because you would get the kind of information that you're used to. And I absolutely agree with you. People who are used to day trading equities and the order book and the order flow and the way that that's changing is a significant part of their trading decision. And that's unfortunately not as easily accessible or transparent when we're talking about foreign exchange.
Is that because it's unregulated to a degree?
It is just because of the way that the market is set up. You know, when you're trading a certain equity that's listed on the New York Stock Exchange, regardless of the institution or market maker that's posting the bid and offer, all that information is getting channeled through the exchange. So they're able to centralize it, and that's how you're able to directly access that with the level 2 system. You know, when it comes to over-the-counter, there's just not that centralized exchange. It's just a network of different dealers and market makers.
Yeah.
And that's why you don't have all the information. You don't know where the last person traded. You don't know what the last executable price was. It could have been significantly better. It could have been significantly worse. All that you have access to is where you have your credit lines, who your relationship is with, and the dealers that are posting their bids and offers to you.
Yeah. Okay.
Does that help a little bit?
It does. It does. Just to go on from that, like you said, Curnex in obviously Europe. Is there one in America that's aligned with FXCM? Because not only is it about spreads, it's also about the stability of the financial institution as well. I don't want to go involved with REFCO right now, but I want to go with somebody who's as reputable as FXCM or as large as FXCM. So is there somebody who's affiliated with FXCM to provide the information as well?
That's a good question. Are you based here in the U.S. or are you based over?
No, Australia, Sydney, to be precise.
Okay. There's a lot of reputable ECN providers would not be able to accept U.S. clients for regulatory reasons, but would be able to accept you. I wouldn't. I mean, FXCM is big. They are reputable, but when you deal with a pure ECN, a pure direct access platform, you're basically dealing with a software company. You're paying them a commission per trade to use that, and all that they're doing is connecting you to the most reputable liquidity providers. So in fact, you'd directly be trading with a Deutsche Bank or Citibank or UBS.
Yes.
The same thing that FXCM claims, but obviously I think the question that you're asking is how safe is where you send your money, right? Obviously you need to send your money to open up an account. The counterparty, the person who's taking your deposit, yes, you want to look at their net capital reserves, how much money they have, you know, these are all questions that you want to ask yourself. And yes, they should be in a regulated environment. You might find really good, you know, a really nice platform for a company based out of Belize or based out of Switzerland, but the regulation in those two countries, no, you know, it just doesn't match. You know, the CFTC have really taken steps in the past 5 or 6 years to protect the safety of your funds, to protect against, you know, questionable execution practices. I'm not sure if anybody is familiar. I actually told Reynaldo I wouldn't talk about this, but FXCM has gone through their issues, you know, since they started. They have had their penalties issued against them. They have been caught with certain practices that were considered questionable, you know, and it's only until recently, because so much competition came in and because regulation became so much better, that they're really able to be more consistent in terms of how they execute your orders. And, you know, I don't know if anybody remembers the REFCO debacle that happened. REFCO was aligned and partnered with FXCM, and when they went under, you know, there was issues regarding customer funds. I mean, that was since taken care of, and it's much safer and it's much more regulated now. What the CFTC basically did is they increased the capital requirements, the net reserve requirements that every FCM has to maintain in order to provide this service. It used to be $250,000. Now it's $20 million for a company to provide this in the United States.
All right, very nice. Any other questions? Oh yeah, so Rupert stated that the market depth, could it be part of a strategy to go with the bigger traders?
That's exactly what the gentleman was talking about now that we just spoke to. Basically, the ability to see market depth is just better transparency and better information as to whether other market participants are doing. That information is always valuable. You know, a big disadvantage that FX traders find if they're coming from a stock background is they can't see volume because there's no centralized exchange, because all the orders are not passing through one centralized place. It's impossible to know exactly how much volume is being bought and sold at any given moment in time. What a lot of companies have provided, and FXCM is one of them, is that they show you the volume for their liquidity pool. They believe that whatever, you know, customers they have, 50,000 or 100,000 customers that are trading with them, they provide an accurate representation of what the overall retail market is doing. So you're able to see some kind of, you know, there's open interest information that are posted, I think, weekly, if I'm not mistaken, on Daily FX, and some charting packages have gone so far as to actually show you little volume bars so that any information that you have about what other people are doing in the market is useful, including market depth.
All right. Okay,
Does that answer your
nice.
question, Rupert? You're welcome.
Right, the other part, I guess I always get this a lot, Michael, is that stocks versus currencies can market makers, institutions, and banks, can they manipulate? Is there a lot of manipulation compared to, say, trading stocks?
It's much more difficult. Anybody who calls himself a trader, with time, will learn to appreciate how important and how significant liquidity and volume is. Anytime you have a more liquid market, all that means is that you have more participants. The FX market has always been and will continue to be the most liquid market. That means you just have so many more people buying and selling for so many more different reasons. I mean, we're speculators. You have people who are hedging. You have people who are, you know, paying payrolls at the end of the month. People are buying and selling euros for reasons that are very, very different from yours, and that's why they quote those trillions of dollars a day in volume. For any one participant, to come in and significantly move the market in one direction or another becomes much more difficult. And the best example is when a central bank comes to try and intervene in the market. The Bank of Japan frequently tries to scare the market. They come in with billions and billions of dollars, and if you look at the charts, when they do that, yes, they can have an impact. They can move the market a few hundred pips sometimes, but in most cases, it does not alter the long-term trend. You know, it's a very short-term kind of move to scare the markets, to kind of, you know, try to just stop their currency from getting stronger because they have a policy to keep their currency weak. It helps their exports. It helps their economy. But, you know, if they do it multiple times, yes, you'll definitely see that. You know, you've heard of central bank interventions. You know, people hear about it. When the central bank scares people, people listen. The Bank of Switzerland, for example, the Central Bank of Switzerland, I can remember last year, they basically set a floor. They said if the market reaches this level, we're going to support it. We're not going to let our currency strengthen to a certain point because it was hurting their economy. And they maintained it.
Yeah.
You know, but that takes no, like for an institutional bank or a retail bank or a hedge fund to do that, not really. The only reason a central bank can do that is because they have a printing press and they have unlimited money that they can do that with. and they have their own reasons. It's not because they're speculating. They're trying to maintain a certain economic policy, you know, to help their producers and exporters and importers. It's not because they're trying to speculate in the market. Usually they lose money because the market continues to trend against them in that particular case. I wouldn't worry about any one individual institution really moving the market and manipulating it. But when we talk about stocks, obviously, on thinly traded volume, you then could have a big money manager, a big hedge fund, you know, with certain hidden orders and dark pools. You know, so a big order can significantly push the price up or down and make a difference. You know, when Warren Buffett says he's going to come in and take over a company, you know, he's got enough money to back up in that particular situation. But you have some stocks that are very liquid and they're very, you know, difficult to manipulate. You have so many more participants. It really all depends on how liquid and how actively traded an instrument is.
All right. Thank you, Michael, for that. The other part is I know in 2008, 2009, when the big, basically I call it a mini crash or a big crash for myself. I know that the reason why I hang on and I stuck with FXCM, there's one part, well, it doesn't happen, I mean, a lot, where the spread basically went to like 50 pip spread. That was the maximum actually I've seen. Yeah. Now with one of my friends who was trading the currency market was with Interactive Brokers, okay, and he got wiped out. There's no guaranteed stop on his end, and it actually spread like close to 500, 800 pips. Yeah. Why does that happen, like compared to a reputable FX provider like FXCM compared to Interactive Brokers?
That's an excellent question. It's in those rare situations when the market goes crazy and liquidity dries up where brokers are able to kind of show how much liquidity they really have access to. It's in those situations where, you know, a company that deals with 10, 15, 20 different liquidity providers are always able to get a price from somebody somewhere. Whereas somebody who only deals with 2 or 3 liquidity providers, you know, they dry up, they stop trading. All of a sudden their spreads are insane where they're willing to buy or sell from. Automatically the customer would see the difference in that particular situation. The other thing to consider is that Interactive Brokers only has a straight-through processing option, which is like the no dealing desk option. They don't have a dealing desk which is actively willing to take on the other side of the trade or make a market. Because FXCM has that dealing desk, it's very possible that that's why, although the spreads got wide, you still had somebody willing to make a market and still able to offer a bid and offer price that was better than their competitor at that time.
Nice, thank you. Right, beautiful. Okay, any other questions? No, that answered your question, or my question, well, Michael. Thank you. Any other questions for Michael? Going once, twice, 3 times.
Thanks, Michael. That was really good.
Yeah, great. That was really great, Michael. I really, really greatly appreciate it. And it is true, actually, in actual fact, when I asked Michael, and he's actually doing this as a favor, and just to give his experience, his knowledge, being on the back end behind the dealing desk. So that's really actually really great. I really thank you once again, and we'll keep in touch. Or if you have any questions for Michael, you can email him, or I don't know.
Yeah, absolutely. I actually included my email address in my contact information. I'm not sure if there's a way to pull that up.
Oh yeah.
I don't mind if you share my email, if there's anything that I can help with. I do want people to remember, though, that I don't work for the company anymore. There's only really so much I can do. If you do have a specific issue with the trade, you know, I can offer my advice. I can offer possible reasons why that may have happened. You know, I can help with those kind of recommendations, but I don't work there anymore, so there is a limit to how much I can help. But I am happy to speak with anybody, to offer my advice, and it was a real pleasure to speak with everybody. I hope I was able to provide some useful information.
Definitely, definitely. I also learned a lot today.
My
Thank you.
pleasure.
Thanks a lot. All right, guys. I will see you tonight at class, and for the rest of you, thanks for coming in, and we'll see you in the next webinar or next workshop. Thanks once again, Michael. You have a good day.
Great evening and happy trading. Good luck to everybody. Take care.
Thanks.